Welcome back to Investing Talk Podcast. Today we are focusing on a healthcare technology firm that's definitely been making waves, especially if you're tracking AI growth stocks. That's Tempus AI. And the big question we're trying to tackle today is, well, it's pretty crucial. Given its really fast revenue growth and how the market's been treating it lately, is Tempus AI actually a good buy right now? Before we dive into all the details, the numbers, the analysis, just a quick reminder, please do subscribe, like, and hey, drop a comment on this episode. And actually, if there's a specific company you'd like us to analyze like this, just let us know in the comments below. We do read them. Okay, so our goal today is pretty straightforward. We want to look at the fundamentals, the financial health, check out the technicals, the chart momentum, and pinpoint the catalysts driving Tempus AI. We're using the latest data we have as of October 24, 2025, really aiming to give you the context you need to feel well-informed on this one. It's definitely a high-growth name.
Yeah, Tempus AI is in a really interesting spot. They're basically an advanced healthcare tech company. They specialize in sequencing, diagnostics, molecular pathology. But the key thing really is how they use sophisticated AI analytics. They take these massive clinical data sets and turn them into insights that are actually usable for pharma research, for big health institutions. It's quite powerful stuff.
And the market certainly seems to think so.
Yeah.
Looking at the price right now, it's sitting at $87.04. That gives the whole company a pretty hefty valuation, $15.38 billion USD.
Right. And what's kind of justifying that big number is the growth trajectory, especially on the top line, the revenue. If you look at their trailing 12 months, the TTM revenue, it's almost $1 billion. It's $951.98 million. But what's maybe more telling is the rate of that growth. Their full year 2024 revenue, $693.40 million. That's a jump of over 30%, 30.38% compared to 2023. So that doesn't just show growth. It really points towards accelerating demand for what they offer.
Okay, that growth is phenomenal. But let's tackle the elephant in the room, profitability. Because this is where, traditional investors might get a bit nervous. We're seeing a TTM net loss of nearly $200 million, minus $199.73 million specifically. And the EPS, the earnings per share, is negative $1.13. So if you're trying to weigh that growth against, financial stability, why would an investor overlook losses like that?
Well, it's a fair question. That net loss really reflects an intentional choice, a strategic trade-off they're making. Tempus AI doesn't pay a dividend, right? They're pouring all that cash back into the business infrastructure, buying data, R&D. You have to see it in the context of them building this huge defensible asset, their data library and platform. And the good news is that those losses are narrowing compared to previous periods. The core idea, the thesis here, is built on the expectation that as they scale up, as they hit that critical mass, their revenue, especially recurring revenue, will start to seriously outpace these big investment costs.
Okay, so the strategy is growth now, profit later. And financially, it seems like they have the flexibility for that. The balance sheet looks okay.
Yeah, it appears flexible enough to give them the runway they need for this strategy. And importantly, you mentioned the market performance. The stock bounced back really sharply from its 52-week low, which was down around $31.36. That rebound kind of suggests the market is, for now at least, willing to forgive those short-term losses because they see the potential in this AI-driven healthcare space.
But that space, health tech, it's incredibly competitive, isn't it?
Yeah.
If their edge is data and AI, what stops a giant with deep pockets like, say, a Google Health or maybe an established diagnostics company from just copying their model? What's the actual long-term defense? The moat.
Yeah, that's the critical question, isn't it? And the moat is actually, I think, quite deep and complex. It's not just one thing. Think of it like a combination lock. First, they have their own proprietary sequencing and diagnostic platforms. Those are hard to replicate directly. Second, and this is probably the real differentiator, they have this massive licensed library of clinical and molecular data that's constantly being fed and updated. It's enormous. So imagine you're a big pharma company. Switching away from Tempus doesn't just mean moving data around, which is already complex. It could potentially disrupt research projects that have been going on for years, projects based specifically on how Tempus structures and analyzes its data. That creates these really, really high switching costs.
Okay. High switching costs. So clients get kind of locked in.
Exactly. It's very sticky. Pharma companies, research institutions, they pay a premium because Tempus is seen as the leader here. They've got the most integrated, the most curated, probably the largest data set of its kind. They're essentially selling the tools and the map for navigating the genomic gold rush, if you like.
That makes a lot of sense. So the loss is basically the cost of digging that moat deeper and wider all the time. Okay, so the moat protects the future.
Yeah.
But what about now? If someone's looking to get in, What does the chart tell us about the current price? Has the stock already run up too much, pricing in all that future success?
Well, the technical picture, the chart setup, actually suggests the market might not be done pricing it in just yet. If you look at the 52-week range, it goes from that $31.36 low up to $104.32. And recently, the stock made a pretty major breakout. It pushed above its recent trading range, and importantly, it did so on sharply higher volume. That higher volume often confirms institutional buying, backing up that confidence we were just talking about.
Can we get a bit more specific on the momentum indicators? Because, things like moving averages can be tricky if you're not watching them every day.
Sure. So what's crucial right now is how the price relates to the key moving averages. It's consistently trading above both the 50-day simple moving average, which is currently around $83.46, and also above the longer-term 200-day SMA, which is down at $63.38. When a stock holds above both like that, it's generally seen as confirmation of a strong, established upward trend.
Right.
And if you look at momentum readings, things like the MACD indicator, it's positive, showing recent price strength. The 14-day RSI, the relative strength index, is at 58.94. Now, that's considered neutral to bullish. It means the stock has good upward momentum, but it's not yet in overbought territory.
Meaning it still has room to potentially move higher.
Exactly. It suggests there's potentially more upside before it gets overheated, technically speaking.
Okay, so clear uptrend. What about key price levels? Where should we watch for potential bumps, resistance, or places where it might find support if it pulls back?
Good question. Immediate support looks to be right around the $80 mark. That level should ideally hold if there's any short-term profit taking. On the upside, the next hurdles, the resistance levels, are around $91. And then the really big one is that 52-week high up at $104, which is also a psychological level. Right now, the chart pattern strongly suggests a continuation towards those higher resistance points. And, this strong technical picture didn't just happen out of the blue. The last 3 months, especially, have been packed with some really significant wins for the company, and those have directly fueled this momentum we're seeing. Back in August, for example, they reported their Q2 earnings, and they absolutely smashed expectations. Revenue came in at $314.64 million. That's an incredible 89.5% growth compared to the previous year.
Wow, 89.5% year over year. That's huge.
It is. And importantly, at the same time, they showed a significant narrowing of their adjusted EBITDA losses, so growth and improving profitability metrics.
And then September brought that big acquisition, right? The Page deal.
Absolutely. Completing that $81.25 million purchase of Page was a major strategic move. It added almost 7 million digitized pathology slides to their already massive data library. But just as importantly, it brought in the first FDA-cleared AI tool for pathology.
FDA cleared. That's key.
Very key. It shows how that long-term data moat translates into immediate commercial power. They bought a tool that's already gone through regulatory hoops and can generate revenue now.
And speaking of regulatory wins, they didn't stop there, did they? There were several FDA clearances recently. For listeners maybe newer to health tech, what does a 510K clearance actually mean? Why is it important?
Right, it's vital in this sector. A 510K clearance basically means the FDA has determined a medical device is substantially equivalent to a device that's already legally marketed. It's not the full, rigorous PMA approval for brand new types of devices, but it's the necessary stamp of credibility you need to legally market and sell many types of medical devices in the U.S. And crucially, it's often needed to get reimbursement from insurance companies. So these recent clearances, like the one for Tempus ECG Low, EF for cardiac issues, or upgrades to their imaging platform, they directly broaden the suite of regulated products Tempus can sell. That opens up potentially massive new revenue streams and makes it easier for hospitals and clinics to adopt their tech.
Okay, so you've got the AI, the huge data library, the strategic acquisition, and these regulatory green lights. It makes sense that institutional investors are taking notice.
Exactly. We saw reports of significant institutional buying, particularly leading up to and around that strong August earnings report. And it's also worth noting, management themselves have been conducting strategic stock buybacks, which is usually a signal they believe their own stock is undervalued.
Right. So that covers the recent past. Let's shift focus now to the immediate future. What are the key catalysts coming up, say, in the next 3 months or so that could really move the needle for Tempus AI stock?
Well, the biggest one, without a doubt, the major short-term event everyone's watching is the Q3 earnings report. That's scheduled for November 5th, 2025. So just around the corner. Analysts are generally expecting them to continue showing strong year-over-year revenue growth. But given the momentum from Page and those FDA clearances, the market will be absolutely laser-focused on whether they can keep up that rapid growth while also continuing to narrow those adjusted EBITDA losses. That execution is key.
And besides their own earnings, are there any broader market events we should keep an eye on?
Yeah, a couple worth noting. In December, on the 20th, there's the major ETF rebalancing. That can sometimes force big funds to buy or sell shares just based on index weightings, causing some volatility. And then, looking a bit further out, around mid-January 2026, we'll get the public disclosure of institutional holdings from the previous quarter. Those are the 13F filings. They basically show what the smart money, the big institutions, were buying or selling in the last quarter of 2025. Seeing strong buying there could add fuel to the fire.
Okay, and then there's always the rumor mill, right?
Yeah.
The speculative buzz. What kind of chatter is out there that could add potential upside?
Right, and this is where things get interesting, though obviously less certain. There are persistent rumors about Tempus potentially deepening its collaborations with some of the big global pharmaceutical companies. These companies are hungry for the kind of detailed molecular and clinical data Tempus has, especially now with the Page assets integrated. Any confirmed major partnership would be a big validation.
I've also heard some chatter about potential deals with major U.S. health insurers getting their platform adopted within insurance networks. That would be a game changer, wouldn't it, for recurring revenue?
Oh, absolutely. That would be huge. It would pave the way for much wider adoption and provide a really stable, predictable revenue stream, which the market loves.
Any other big what-ifs floating around?
Well, there's also ongoing speculation that Tempus might make a move into the European market. Europe's a big, high-growth area for diagnostics and AI health tech. Whether that would be through another acquisition or maybe a significant partnership, we don't know. But if any of these rumors, pharma deals, insurer contracts, European expansion, actually get confirmed in the coming months, that could definitely create substantial further upside. It dramatically increases their potential market size.
Okay, so if we try to tie all this together into an investment thesis, before we get to the analyst consensus, let's just quickly reiterate the main risks here. What are the immediate concerns investors need to keep in mind?
Yeah, absolutely crucial to balance the excitement. We have to reemphasize the profitability risk. The market's being patient now, focusing on growth, but that TTM net loss of nearly $200 million, it's a real number. And eventually, the company needs a clear path to turning that around. That patience won't last forever. Second, there's always sector risk in healthcare. Regulations can change quickly, impacting reimbursement or data usage rules. And while that data moat seems strong now, you can never completely rule out intensified competition, either from existing diagnostics players getting smarter with AI, or maybe a surprise entry from a big tech firm deciding to really commit to the space.
Right. Those are definite risks to watch. But despite them, as you mentioned, the analyst community seems pretty positive, almost unified.
Yeah, remarkably so. Looking at the professional analysts covering the stock, we're seeing somewhere between 13 and 16 analysts rating it as either buy or strong buy.
Yeah.
And their average 12-month price targets generally fall in a range from, say, a supportive $78.31 on the low end, up to a pretty aggressive $110 on the high end. So that consensus definitely leans bullish. They seem to be prioritizing the growth story over the short-term red ink.
And our sources reflect that same confidence.
They do. The overall assessment we synthesized gives Tempus AI a strong overall bullish rating of 8 out of 10. The reasoning behind that high score really comes down to that powerful mix. The accelerating revenue, the resilience it showed bouncing off those lows, the positive technical momentum we discussed, and crucially, that strong integrated long-term advantage built on innovation and, most importantly, that massive data library moat. Healthcare tailwinds help too, of course.
So wrapping this up for our listener, what does this mean for you? Is Tempus AI something you'd look at for a quick trade, or is it more of a long-term portfolio holding?
Well, based on the analysis, it seems potentially attractive for both types of investors, actually. For short-term traders, there's definitely potential volatility and opportunity around that upcoming November 5th earnings report. But I think primarily it's positioned as a stock for long-term investors, those who believe in the secular growth trends of AI and healthcare and precision medicine. For them, the current price might be seen as the cost of entry to own a key player, potentially a gatekeeper, of valuable genomic and clinical data for years to come.
Yeah, Tempus AI really does sit at that fascinating intersection of AI and precision medicine. They seem to be building something quite unique with that data library, especially now layering in assets like Page.
Exactly. And building on that, perhaps the final thought for you to consider is this. While the revenue growth and acquisitions like Page are impressive, the critical factor for sustaining this valuation and pushing it higher will be monitoring how quickly Tempus can translate that massive data asset and its recent regulatory wins into a clear, believable path towards adjusted EBITDA profitability. That upcoming Q3 earnings report on November 5th, that's going to be a key data point. It's the moment we'll get a clearer signal on whether the significant cost of building that impressive moat is starting to translate into scalable, profitable operations. That's really the crucial application of everything we've discussed today.
A perfect final thought to mull over as you do your own research. Thank you for tuning into this analysis.